The Name of the Game is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. Welcome to Steve Savant's Money, the name of the game. Hi everyone, I'm your host Steve Savant, syndicated financial columnist and money gamer extraordinaire. The American tax system needs an overhaul, but with the government locked in gridlock, there doesn't seem to be any solution on the horizon. So until the logjam breaks, we need a couple of strategies. On today's show, we're featuring our end-of-the-year tax planning for 2013. There's still time for you to be proactive, to do some planning and lower your tax bill if you act now. And here to talk about some of the tax planning that can really save you money is Ken Davis, certified financial planner, CPA, and syndicated financial columnist. Remember, it's your money. In the G segment, it's game on as we walk you through the basics of our tax system. In the A segment, we'll outline your sources of income and how money is taxed. In the M segment, our money mentor, Ken Davis, will walk you through 5 things you can do for 2013. And in the E segment, we'll give you 5 things you can do next year to keep more of your own money. Well, welcome to the show, Ken.
Hey, Steve.
Well, I'm talking about taxes, and I'm so sorry I was out on the U.S. debt clock again. We're over $17 trillion, and they predict right now, based on taxes, revenue, everything that we're doing right now, that we may hit $20 trillion by the time the 2016 election. You think that's going to affect the election?
I hope so. I hope we get some reality into the people who are voting, that we get some leaders in there. I don't care what party it is that's actually going to pull it off. It's almost laughable. They're saying, oh, goody, the tax deficit's only going to be $400 billion this year. And I'm going, there's a time we would have gone, oh my gosh. And now we're going, relief.
We're conditioned to these things. I was out on the website, truthandaccounting.org. It not only includes the $17 trillion, but it also includes all the government obligations and pensions. That thing is past $70 trillion all in.
I know, it's crazy. They got all over the cases of corporate America because they were promising all these pensions, but then really weren't funding them. Mm-hmm. Well, now we have a government that is over the top with a whole lot of promises where the money has not been put aside. People don't realize there are not stocks and bonds in a trust somewhere waiting for them to pull money out. This is basically says, oh, well, we got this bill now. Let's go out to the taxpayers and tax them and pull the money in. Mm-hmm. It's a transfer of wealth from the working generation to the retired generation.
When I think about doing 1040, I know it's mind-numbing and it's not that attractive, but when I'm doing my taxes and preparing for it, I'm always looking at, here's my gross income, my adjusted gross income, and something that nobody pays too much attention to right now, modified adjusted gross income. Give me a little potpourri from a CPA point of view.
Well, from my perspective, what's happened is the government realized they couldn't go to the public and have the commentators on the nightly news say tax rates increased. Very unpopular for getting voted into office. So what they do is they go after the quote-unquote rich people, which in many cases turn out not to be so rich. And they nip, nickel and dime us to death. Mm-hmm. They use this concept of taking AGI, which is on the bottom of page 1.
Adjusted gross income.
Yeah, not taxable income, which is a much lower number, but AGI, which is a higher number, and then add more to it, like half your Social Security, tax-exempt interest from municipal bonds. And that number determines if you're going to include Social Security income as being taxed, whether you're going to alternative minimum tax, whether you get to deduct your medical expenses. AGI is all over the Internal Revenue Code, and it's under the radar. It's hidden. Mm-hmm. They're trying to hide what they're doing to us. They're actually increasing taxes effectively.
By using the modified adjusted gross income.
By using this to tack on all these little different pieces, when in fact they are raising effectively our tax rates, but it's much easier to pass that by the taxpayer and not get caught.
I think the actual Obamacare credits that everybody's hoping for in the middle class, I think that's actually scheduled on the modified adjusted gross income.
Well, and it's interesting. I mean, here's a group of people that are on the low end of income that are getting credits against their Obamacare premiums. And in fact, the determination of whether they get, how much of a credit they get, if they get it at all, is based again on modified adjusted gross income. Do you think these people have a clue of what that is? I mean, some of them may not even be filing because they're not really, making income, or somebody doesn't think they're making enough income, but maybe they're taking Social Security income and that's added into the formula and they didn't realize it.
So really, when I'm thinking about it, we're getting our gross income, then we have our deductions and so forth, then we get down to our adjusted gross income. Then they add back on some income on our modified, and that's the number we're looking at on these credits.
That's right, and AGI hasn't taken out itemized deductions, standard deduction, or exemptions for your kids and yourself. So this is this larger number, and then they're adding more to it and calling it modified adjusted gross income. And just to add more confusion here, there are various definitions of modified adjusted gross income depending upon which of these different tax tactics the government is using to beat us up and take more money from us.
It really is important to be with a tax advisor.
Oh, absolutely. You really should be doing tax projections at year end. You may think you have a fairly simple situation, but if you're in retirement and have Social Security Social Security income, you may be able to do some things to help reduce the taxation of that, which we'll talk about in our later sessions.
Well, when I'm looking at the basic taxes, I'm getting ready to do my 1040. A lot of us just take our shoebox and we empty it out on the table. We try to make some heads or tails out of it. Is there a way to really do something that has, from an organizational point of view, how can I organize myself as a taxpayer before I see a person like you as a CPA? How can I save some time and maybe even some billable hours here by having this all ready to go?
Well, when you hand them the shoebox, they have to sort it out. They have to summarize it. You're paying for that time. If that's something that you can do and you want to save money with your advisor, then I would highly recommend you do that. QuickBooks or tax accounting or accounting software will now hook up to your bank account. So if you're even technically proficient at all, you can actually connect to your bank accounts, download your information, and you can start dealing with that maybe monthly, so that by the time you get to the end of the year, you have all this sorted out and ready to go, and you can put out typed out or even electronic files you can give to your CPA and ask them about that. They might be able to help you.
I think a lot of people forget that if you do a little bit of pre-planning before you see the CPA, you might be able to save yourself some fees.
Oh, absolutely. When I used to practice in public accounting, which I don't prepare tax returns anymore. They used to walk in with the shoe boxes, and it's like, oh my gosh, it's hours and hours of work to just summarize all that stuff.
Well, that's what we're trying to do, is do a kind of a end of the year summary so that you can save some money. If you want more information on the basics of taxation that can help you lower your tax bill, just email me, steve.savant@ashbrokerage.com. It's free, and it includes an easy-to-understand tax bracket grid so you can determine your federal tax bracket. It'll take about a few minutes. Is saving money on your taxes worth a few minutes? I bet it is. When we come back from the break, Ken and I are going to walk you through some of the various forms of income and how they're taxed in the A segment of our show.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Welcome back to The Name of the Game. I'm Steve Savant with Ken Davis, certified financial planner, CPA, and syndicated financial columnist. And just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor or legal counsel. Coming up in the A segment, Ken and I are going to walk you through some of the various forms of income and how they're taxed. Well, Ken, in our second segment, our A segment, I want to talk about sources of income and how your money's taxed. Now, most of our people watching, consumers, say, well, a lot of us have jobs. We have W-2 income. We have maybe some interest from the bank. Some people are actually consultants or have self-employed. They're getting 1099s from different sources. Let's talk about that income first.
The 1099 income?
And W-2. Give me the difference.
Yeah, well, W-2 is basically wages. You work for an employer. You are an employee technically under the law. And so that type of income is treated as ordinary income and has certain aspects of it to it, including the fact that there's FICA taxes being paid on it. 1099 income is for, say, independent consultants who they don't work for just one employer. They might work for several clients. They're going to get a 1099. They're going to be responsible for paying their own FICA taxes, and then actually it's worse because they pay the employer portion and the employee portion. And that has other impacts, the kind of income, whether it's active income or passive income or other, can have an impact on the treatment of various tax aspects throughout the code.
Now, I've noticed that besides having our taxes, our earnings tax and anything, if we're a consultant, we have 1099. If we're by our self-employed, we're paying extra on, you said FICA, Social Security, Medicare, Medicaid. But I also noticed that there's this thing called the alternative minimum tax, which for years was never marked to inflation. Now they've kind of caught up with that, a little bit about that. Some Americans are still subject to the alternative minimum tax. So what do I have to watch out for that?
Well, basically the intent is to go after people that make more money. What was happening is back, before the changes in the 80s, the tax law, people worked hard at doing tax shelters and stuff like that, and they found ways to accelerate or increase their itemized deductions or above-the-line business types of deductions, depreciation, oil drilling, intangible drilling costs, stuff like that. And the government came in and said, okay, enough's enough. You can't put your income at zero.
They're gaming the system.
Yeah, you guys are wealthy. You need to pay your fair share in taxes. So out comes the alternative minimum tax, which essentially takes and runs a whole different tax formula. It gets rid of certain deductions. It limits certain amounts of deductions. And if you exceed those, then you're going to start paying the higher alternative minimum
Well, I
tax.
understand the affluent and why the intent, but then it migrated down to the middle class, and we had people that were not affluent, not rich, not wealthy, paying this tax.
Yeah, what was interesting is that they give you a certain exemption. A certain first amount of money isn't going to be subject to AMT, and once you cross that threshold, you will. Well, what they didn't do is inflation adjust that threshold. So for the last quite a number of years, we were waiting until the end of the year to see if Congress was going to extend and increase these exemptions, this threshold, and finally they made it permanent, and it's now inflation adjusted. So, with inflation, you're making more and more income. You're buying less and less with that income than you did before, but you have more income. So more and more people started to cross this threshold, and that problem has been solved.
People make money with capital gains because of the assets they're invested in, and that is treated differently than some of the areas like W-2 and 1099 income.
That is correct. Generally, if you ask somebody before what long-term capital gain, meaning capital assets that have been held for more than 12 months, what's the tax rate? They would just say 15%. And that was true. Today, those that reach a 39.6 tax bracket for regular ordinary income taxes now have to pay a 20% capital gain. And then on top of that, they may find themselves with a 3.8% Obamacare, so it's effectively 23.8.
Now, I've noticed when we're talking about basic ideas like income, that it's kind of important then to find out, if I have these, this is how I get taxed, is there any way to defer this? Are there anything to look at that could maybe even at least delay it out a little ways?
Well, in fact, there is. And for people that are in an accumulation phase, interestingly enough, well, first of all, you have capital assets defer, like a piece of raw land. Until you sell the property, there's no gain. Annuities, you can put money into annuities. There's no current taxation of any of the earnings. There is no 1099 forcing you to be taxed until you start taking money out. And then life insurance is probably one of the most favorable tax treatment things. People don't think of life insurance as cash accumulation, but they can be designed. There's a lot of flexibility in design to reduce the face amount of the insurance, maximize the cash value buildup. You can build tax deferred. You can take out your original money tax free. You can loan tax free. And then at death, all the deferred gains go away and becomes permanently deferred or basically tax-free.
There's some mathematics behind
That
the
is
power
correct.
of deferral. The longer I can defer, the better it looks like from an economic point of view.
Well, that's exactly right. I mean, wouldn't you love to be able to go to the bank, get an interest-free loan, and then invest it and not have to pay them back any interest, just the principal, when you finally sell your assets? Well, when you defer your taxes, that's exactly what you're getting is an interest-free loan from the government of the taxes that you now owe them, but you push it off to the future and get to invest it, making more money. When you finally sell it, yes, you have to give them the original taxes plus that. Although if you may have losses in between, then they'll never get the taxes. So you don't either, but...
Well, just keep in mind, though, that one of the powers of looking at taxes now might be able to mitigate our tax bill by the end of the year. If you want more information on the basics of taxation that can help you lower your tax bill, just email me, steve.savant@ashbrokerage.com. It's free, and it includes an easy-to-understand tax bracket grid so you can determine your federal tax bracket. It'll take about a few minutes. Is saving money on your taxes worth a few minutes? I bet it is. When we come back from the break, Ken and I are going to address the 5 things you can do before the end of the year to lower your tax bill in the M segment of our show.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Welcome back to The Name of the Game. I'm Steve Savant with Ken Davis, certified financial planner, CPA, and syndicated financial columnist. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor or legal counsel. Coming up in the M segment of the show, Ken and I are going to address the 5 things you can do before the end of the year to lower your tax bill. Okay, Ken, I'm excited about this segment because now we're talking about the 5 things you can do this year to help your 2013 taxes. And I love things like that. And your first thing out of the chute is, we have a lot of people that are business owners, and people always think, well, I'm a business owner, but they could be working out of their home. They could be self-employed. They have a business, or they could be a big corporation and a firm. Talk about this Section 179. Time to buy some assets here.
Well, yes, if they purchase their asset during 2013 and place it into service before, on or before December 31st, in other words, you buy a computer, you set it up, and you use it for email on December 31st, you get to deduct the entire value of that if it's used for business. Okay? So all kinds of, maybe folding machine, because you do a lot of mailings, different kinds of equipment for small businesses, maybe a new phone system, stuff like that.
The limit, the use of 179 seems to be very high, so there's a lot of purchasing power to that.
Well, I believe you can deduct up to $500,000. Now, I would caution the viewers, make sure you work with your tax advisor. Certain kinds of property have limits on them. There's certain amounts of how large you are and whether you can deduct it. You really do have to purchase it, set it up, and put it in engage it before the end of the year. So make sure you follow the rules.
Now, Ken, I noticed that as a CPA, you tell people to fund their IRAs and qualified plans now, and I'm thinking, well, don't I have till April 15th?
Well, that's correct, but the earlier you get it in there, I mean, where's your money now? Making nothing in a bank account or making 1% in a money market fund? You stick it into an asset that's intended for retirement. Hopefully, you have the potential of making substantially higher amounts of money. So get it to work earlier and sooner, and it's tax deferred instead of leaving it somewhere where it might earn a paltry amount of interest and be fully taxable.
Now, a lot of people have non-qualified investments in stocks and bonds, and a lot of times we need to kind of look at what happened this year. We might have some winners. We might have some losers. How can I harvest the tax arbitrage with that?
Well, there's your opportunity to redeploy your assets. Maybe you're saying, gosh, I've had this really big winner, but I'm thinking that it might have hit its top and it's time to get out and take my winnings and move on, but you're going to have to pay taxes if you sell that stock. Well, most likely you have some losers in your portfolio as well that you can look at the ones that you think, this isn't going to come back, I'm going to take my losses and move on. You can now use those losses against the gains. And again, the laws on capital gain treatment, you want to make sure you understand short-term capital gain, short-term capital losses, long-term capital gain, long-term capital losses, how that all works together. And you probably should see your tax advisor.
Yeah, for most of our consumers that are watching our show, they're going to go to their tax, but that we're bringing it up proactively can really mitigate your tax bill.
Yeah, look at your portfolio, then go see your CPA or tax advisor and see what you can do.
Ken, I know we have a lot of people who have big hearts, but they're willing to make some contributions at the end of the year. Talk about charitable giving at the end of the year. This is a tactic sometimes we kind of forget.
Well, first of all, make sure you do it early. Don't wait till the very last day, because there's been tax court cases where they wrote a check and they didn't get a deduction even though it was written on 12/31. Why? Because it didn't cash to the next year, and the government argued they could have canceled the check. So do it earlier, get it canceled, then they can come back and slap you on the hand. The other thing is charitable gift annuities. Give money to your charity. Many of them have charitable gift annuity programs. Well, they will then pay you an income on that contribution back for the rest of your life. You get a partial deduction. You get a little lower rate of return than you would in a commercial annuity. That's why it's a gift annuity. It's designed about half of the annuity will be left for the charity at your date of death.
So that's a really good tactic you can do right now.
Well, yeah, and the thing is, it's based on your life expectancy. So even in these low interest rate environments, somebody in their 70s or 80s could very well get a 5, 6, 7% distribution because it's not based on interest, it's principal and interest, and they're basically going to pay you till you pass away.
Based on your life expectancy.
Based on your life expectancy, and then they get to keep the rest as essentially a charitable contribution.
It sounds like almost like a mortality credit in some.
Well, in a way, it's really nice because you might get 6% instead of 1% in your bank.
Well, I know there's a lot of things changing on foreclosures and short sales, and this may be, who knows, they may extend this again, I don't know. But right now, if you're going to do it, if you're going to play this game, maybe this year's the year to do it.
Yeah, it's kind of crazy. In the past, if you foreclosed on the house, you'd think, gosh, I get to walk away. No, the government comes in and says, the debt that you didn't pay off, if the house sold for $400,000, the debt was $500,000, you had $100,000 forgiveness. That's considered cash and taxable income. Under the current law that was put in place because of all the foreclosures and short sales, under certain circumstances, there is no taxation of that. And that expires at the end of this year unless they change the law.
So that's a real heads up for people in foreclosure or short sales, and it is occurring right now.
Yeah, if you got a short sale that's just going on and on and on and on, and you don't think it's going to get done before year end, you may want to consider talking to your advisors and doing a foreclosure. It's not as attractive from a credit standpoint. Make sure you deal with your advisors and look at not only the taxes but the other consequences.
Yeah, I'd want a tax attorney and a tax CPA in on this to really make sure I'm obeying what's going on in the law and really understanding what I'm doing before I do that. Well, I'm looking at all these. These are 5 things that we can do right now, and that can really help us mitigate some of our tax bills. And you know, what I always like to do is I like to be proactive, but sometimes we wait to the last second. And of course, we're doing this show right at the front end of the holidays in December, and people say, wow, I wish I would have known this. Well, when I want to talk about things that we can do next year in the next segment that can really help us kind of prepare. With about 10 seconds, Ken, planning, how long does it take to do this right?
Maybe a couple hours. I mean, you have to gather some information, meet with your advisor, maybe pay them a fee, but the taxes you save may be a lot more, and they may not be. But
is 2 hours worth saving money on your taxes?
Yeah, go see your advisor and get it done, and do it now because everybody's going to want their attention if they're looking to do planning right away. So,
if you want more information on the basics of taxation that can help you lower your bill, just email me, steve.savant@ashbrokers.com. It's free. And it includes an easy-to-understand tax bracket grid so you can determine your own federal tax bracket. It'll take a few minutes. Is saving money on your taxes worth a few minutes? I bet it is. When we come back from the break, Ken and I are going to talk you through the 5 things you can do to lower your bill in 2014 in the E segment of our show.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Welcome back to The Name of the Game. I'm Steve Savant with Ken Davis, certified financial planner, CPA, and syndicated financial columnist. And just a heads up, before moving forward with any of the ideas you hear on our show, consult your tax advisor or legal counsel. Coming up in the E segment, Ken and I are going to talk about the 5 things you can do next year to lower your bill in 2014. Well, Ken, I want to talk about planning. I'm always planning. This whole show is about planning for 2013, but actually, since we already got our juices flowing in planning, I want to stay in that mode for a little bit and start thinking, what could I do? What are some of the things I could do in 2014? I want to do this instead of waiting till the last second all the time. I'd like to be proactive and start my tax planning right away, starting in January, February, start to really look at this. You said at the last segment, it takes a couple hours to really sit down and do some math and calculation with a good tax advisor. And I really want to do that and be proactive. So let's talk about the first one. You're talking about making your contribution to your IRA or your qualified plan contribution early. Talk about the power, or actually the negative of procrastination and the power of accumulation.
Well, a couple things. One, if it's sitting in a bank account earning no interest or 1% if you're lucky in a money market fund, you're not doing you much good. And then to add insult to injury, you're paying taxes on it. Put it in a tax-deductible IRA or qualified plan and then defer. And the sooner you do that, the sooner you start your accumulation at the potentially higher rate of return, and you're not paying current taxation on it. So do it early. Get it going now. the old name of the game was tax deduction. Well, qualified plans give you tax deduction, but tax deferral is just as powerful, and in some cases more powerful than tax deduction. And that requires some planning ahead of time and getting your money put away. What are you waiting for? Get it done, put it into things that at the end of the year you're not going to get a 1099. Take it out of that CD or money market fund or bond fund or municipal bond fund. Yes, I said municipal bond fund, tax exempt, but it does impact taxes anyway. That's a topic for another show.
It can, yeah.
Put it into a tax deferred account. It can be raw land stocks that have capital deferral and capital gain. It can be annuities, life insurance, stuff like that. Deferral is the name of the game. It used to be tax deductions. Not many tax deductions left. Use those first, then use tax deferral devices.
Well, I like the idea that if you're over age 50, now remember there's still that extra money, that catch-up provision, as well as if you're in a 401k and your employer is doing any kind of a match. I love that, and at least you should make contributions at least to the match.
Absolutely.
Well, because I'm all over that. Now, this is interesting. I've heard Ken talk about this before about annuities, but you say annuities with an LTC benefit link. And I know that a lot of people are sitting there going, I'm probably going to have to use this when I get older. Talk about the value of this.
Well, the fact of the matter is we find in our profession that rarely are annuities used before people pass away. It's kind of the backup type place. They stick money in. There's no taxation on it. It's the last thing they want to take out and trigger taxation. So it usually ends up going to the kids. It's a terrible way to leave money to your children because all those deferred taxes come due and it's going to be taxed in their pocket, not yours. It's not an estate tax. It's an income tax on the beneficiary when they receive that money. Long-term care, you can still do all the things I just talked about, but now if you need to pay for expenses for your long-term care, you can take it out of these special annuities that have a long-term care rider on them that multiply your benefit. Like put in $100,000, maybe it'll pay $200 or $250. I don't know. It depends upon the state of where the market is. But when it comes out tax-free if it meets the IRS guidelines.
Well, I like that because now if I have to reimburse, I paid my bill and I paid it out of my annuity linked that's approved under the Pension Protection Act, I could actually pull money out of this free to pay those expenses.
Right. You're sitting there with $100,000 in an annuity and you're thinking, gosh, I don't want to use it. I have to pay taxes. It's going to go to the kids. That's going to be bad. Go ahead and enroll it. Tax-free 1035 exchange from one annuity to another. And the new annuity can have the LTC linked benefits attached to it that can allow you a mechanism to get it out tax-free.
I love that idea because it's not a use it or lose it proposition with an annuity and LTC. If you don't use the long-term care, no problem. If you need it and you take money out for long-term care expenses, that comes out free. Ken, I noticed that you're saying on one of your big lists here, you talk about buying capital gain assets such as real estate, stocks for deferral, capital gain treatment. Talk a little bit about that.
Well, again, it's a deferral. Envision a piece of raw land in an outlying area around your main metropolis, and you're in a growth area like Arizona is, or say Las Vegas, and the snowbirds are coming to town. They're buying their real estate. Buy the raw land. There's no current taxation. There's no rents to be paid tax on, and then 5 years down the line, it grows. You quit. Get out capital gains taxes.
So you should start looking now as you're planning for 2014. I know we've talked about converting Roth IRAs before. We need to do a little math on that. There could be a reason why you'd want to convert.
We went through a big thing a few years ago about Roth IRA conversions, and what was interesting is they were saying if the tax rate at the beginning and the end are the same, it really doesn't matter. If tax rates are going to be higher, which they are now and more likely will be in the future, Roth is better. But what they're missing the point is that Social Security income is taxed based on distributions. And if you're from a regular IRA, but if you have a Roth distribution, that won't count as part of the formula.
You also say with a little bit of time we have left, buy cash value life insurance.
Cash value life insurance is a bit of a surprise for people, but it works a lot like a Roth IRA. No deduction up front, tax deferral in between. Can be, if done right, tax-free at the end if the policy is still in force on the day you pass away. And you can access the money tax-free.
Well, that's our show for today. I want to thank Ken Davis for being my special guest and today's Money Mentor. And remember, you can follow me on Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And don't forget what the good Reverend John Wesley once said, make all you can, save all you can, give all you can. I'm Steve Savant. See you next week.